Today, I would like to analyze Union Pacific. They are one of the biggest railroad companies in the world. They operate in over 23 US states. You can see here is a map. This is something very essential for the infrastructure, and they have a very strong market. You can see here it's a cheap way of shipping stuff around the country. And when we take a look at the stock price, we can see in the 1 year chart, we are down 2%. We had up and downs. So from the ups here, we are down about 7%, 8%. And in the 5 year charts, we can see we are up 26%. So we're going to take a look at the financials to find out if this company is undervalued right now. The first thing we can recognize about Union Pacific is the market cap of 142 billion US dollar. This is when we take the current stock price, multiply with the shares outstanding. So I would say it's already a huge company, but there is still enough room to grow. We can also see here the dividend yield around 2.29%. And we can see here as well, the dividend did increase many years in a row. And the rate is also quite good. We can see here sometime over 20% dividend growth. Now it's slowing down around 2 and 1.5%. But overall, it's looking very interesting. We're going to take a look at the financials now. The first thing we are looking for is revenue growth in the last 5 years. We want to invest in a growing business, not a declining business. So we can see here 2019 around 21 billion US dollar. Then we had a decline. Mostly because of COVID, I would say. We have a recovery again. And then in 2022, we have finally the 14% growth. And now in 2023, we have a 3% decline again. So this is mostly because the economic turn down. And I would say overall is still a revenue growth. Of course, we would like to see a higher growth in the last 5 years. But for me, it's still a check here. The next one we're looking for is free cash flow growth in the last 5 years. This is a very important number because the free cash flow can be used for paying back the debt, to pay the dividend, to pay the stock buybacks, or to invest in the business. So we can see here 2019 it was around 5.1 billion. Then we have around 9% growth in 2020. Then again around 8.6% growth in 2021. Then we had the decline close to 6%. And then 2023, we had the decline again around 17%. So overall, it's a free cash flow decline. We don't like to see that. Of course, if there's a reason, maybe the economic downturn or something like this, then we can understand it. But it's not a check here, and we need to check if this decline is keep going like that, or is this just will have a recovery in the future. The next thing we're looking for is free cash flow yield over 4%. This can also tell us about the valuation of this company. So what we're going to do now is we're going to take the 4.77 free cash flow, and then we're going to divide it with a market cap of 142. And then we're going to get the free cash flow yield. So the number we get is 0.335. This means round about 3.35% free cash flow yield, which is under the 4%. So this company could be still a little bit overvalued, especially because we have a free cash flow decline. But if we believe in the future the free cash flow will grow again and will come to the 6 billion that it was in 2021, then actually this company could look undervalued. We can calculate this with the 6 billion quickly. So if we take 6 billion instead, we would have a free cash flow yield around 4.2%. This looks better, but right now it's not a check here. It's not for over 4%. The next thing we're looking for is debt to free cash flow ratio under 5. So this means the company can pay back the debt with the free cash flow in under 5 years. A very important number to me, because if the company has too much debt and cannot repay back the debt, then it could risk to go bankrupt. So what we're going to do now is we're going to take the short-term debt. We can see it here, 1.78. And then we're going to add the long-term debt as well. We can see here it's 32.4 billion. and then we're going to divide it with the free cash flow that we had, 4.77. So then we're going to get the debt to free cash flow ratio. So what we're going to get is 7.16, and it's not under 5. So what does it mean? In a little bit over 7 years, we can pay back the debt with the free cash flow. It's not a great number, but I would say it's not a horrible number as well. So you need to think by yourself, is this a good number for you or not? So the next thing we're going to take a look is their cash on hand. So how much money this company has in the bank. We can see here around 1 billion, which in my opinion is not very much considering the size of this company and considering the amount of debt this company has. So yeah, it's not a check here. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. And we like to see that, especially if we think the company is undervalued. So we can see here what's going on. We can see here 2014, it was around 0.9 billion shares outstanding. And then we can see it decreased many years in a row. This means the company buys back their own shares. We can see here it's actually incredible. They buy back a lot of shares, sometime over 4%, but we can see here it also slowed down 2023, just 0.6%, and then 2024, 0.2%. So they're slowing down with the buybacks, probably because they have a lot of debt and not much cash on hand. We can see here as well repurchase of common stock. So yeah, we can see here the buybacks, 2019 over 5.8 billion, and 2022 also a good number, 6.2 billion. Yeah, so they buy back a lot of shares. We can also see here the dividend they paid. And what we can tell as well, that they can pay the dividend with the free cash flow yield. We can see here the dividend is 2.29% and the free cash flow yield is around 3.35%. So they can pay the dividend. And that's here is checked because shares outstanding did decrease. We like to see that, especially if we think the company is undervalued.